Brad Williams, Frugal Finance. The question here, what is a home equity line of credit? HELOCs. A home equity line of credit, a HELOC, is an open-end line of credit that allows you to borrow repeatedly against your home equity. A HELOC lets you borrow money using the available equity in your home, which is the value of your home minus the amount you owe on your mortgage. Only consider a HELOC if you're confident you can keep up with the loan payments. If you fall behind or can't repay the loan on schedule, you could lose your home. Borrowing from a HELOC, if you get a HELOC, you can generally spend up to the credit limit anytime during the borrowed period, also called the draw period. The draw period could last 10 years, for example. Typically, you use special checks or a credit card to draw on your line of credit. Ask your lender about fees and minimums. Lenders can charge certain fees when you get a HELOC. Some plans also require you to borrow a minimum amount each time, for example, $300, or keep a minimum amount outstanding, while other plans require you to take an initial amount when the credit line is set up. You can make payments on your HELOC during the draw period, and many HELOCs have minimum monthly payments based on your current balance. If the value of your home decreases significantly, your lender might decide not to allow you to take any additional credit under your HELOC plan, which may result in you not having access to as much money as you thought you would. The lender might also freeze your ability to take out additional funds if your financial circumstances change and your lender does not believe you'll be able to make your payments. Entering the repayment period, after the draw period ends, you stop being able to borrow from the HELOC and enter the repayment period. Your lender may set a schedule so that you can repay the full balance, often over 10 or 20 years. Monthly payments are often significantly higher once you enter a repayment. In some cases, you may have to pay back the whole amount you borrowed as soon as the repayment period begins. HELOCs usually have a variable interest rate, so your payment may change from month to month. Some HELOCs let you convert some or all of your balance from a variable rate to a fixed interest rate. Fixed rate is usually higher than the variable rate, but it's also more predictable. Good thing about HELOCs is there's flexibility, and if you're diligent and you're responsible, they're great. They're great for small businesses to a point. Sometimes you can get over levered, but in terms of the nightmare, FYI, I owned a mortgage company for a long time. You'd be surprised how abusive people get with these HELOCs. I'd ask, when you have a $60,000 HELOC balance and you want to refinance, what did you do? Oh, the vacations were great. Oh, my car. I bought a car, or I bought a couple cars. You'd be surprised what people do. Now, buying a car via HELOC could be advantageous. There could be some tax advantages. You'd have to talk to an accountant, but there could be some advantages there. You could use it for college education, etc., etc. But just keep in mind, it is debt. You have to be responsible and try to pay it back sooner than later. Comment. Let me know your experiences with HELOCs. Brad Williams, Frugal Finance. Thanks for watching. Hope that helps. See you soon.